Well, thank you for joining me at the quarterly chart party. It's October and we got a bunch of stuff to cover. As many of you know, our quarterly chart party is a little bit longer format where we go through a series of different charts. I'm going to do the economic outlook and I'm going to leave the market outlook to my father just after that. With that, let's get right into it. We talk about this often. What are the three things we do for our clients? We want to be their go-to advisor, we want to optimize their wealth, and deliver service with integrity. And I couldn't think of anything better than go-to advisor on this topic than to be able to answer questions about the markets. So if you have questions on this presentation or previous presentations or just about the markets in general, make sure you send them here. Well, let's get right into it. What's our economic outlook? Well, I'm really going to talk about three big pieces of economic news that seem to be affecting people that I want to make sure we cover. One, tariffs. Tariffs are a big deal. They still are something that people are talking about on a regular basis. As a result, we're talking a lot about inflation. And as a result of inflation, we're talking a lot about the Fed and cutting rates. And what all these things mean for our economic outlook. So let's get right into it. First and foremost, this is a chart on the rate of tariffs in the United States. This chart goes back to 1900. And you're going to notice a couple of things. One, tariffs seem to be really, really high back in 1900. But here's the tough part about this chart. People keep comparing this chart to times past. We used to have trade deficits or trade surpluses when. It used to be like this when. During the Great Depression, our tariff rates were X. You have to remember, let's zoom in on this chart quickly. If you look back to like 1932, we had tariff rates about the same as the blue line today, the statutory tariff rate of about 19%. 1932, we're in the Great Depression, right? This is after the 29 crash. We had massive trade surpluses, but also about 1 in 3 Americans lived on a farm. You know, even in the 1960s, our economy at the end of the 1960s was 40% manufacturing. Today it's closer to 10%. And about 2% or less of our country is farmers. It's hard to compare tariff rates today and what they mean with what happened before. And one of the reasons is because of manufacturing. Manufacturing used to be, frankly, a bigger deal. And you were fighting for manufacturing prowess. Now, services dominate the economy. And frankly, services aren't nearly as easy to tariff, nor do they usually even have tariffs. Interestingly enough, you know, that orange line way at the top there, that was the proposed Liberation Day tariffs. No wonder everybody got scared. We'd never seen anything like that. But interestingly enough, there's a little line down there, year to date, 2025, effective tariff rate is about 5%. 5% is not a ton. It's definitely higher than it was. It's higher than it was in 17, higher than it was in, during the last administration, but it's not exceedingly high. And remember, we bring in about $4 trillion worth of stuff. And subsequently, about 1.7 of that is actual stuff, not just energy, that can really be tariffed. You got to give some credit to the American business person. They were good at avoiding tariffs. We're not suffering the statutory rate. There's a lot of deals going on. There's a lot of things that are changing. That's not overall good, but the effective rate's 5%. At that rate, even at a 10% rate, we've said this before, we're talking about $170 billion in taxes. Well, it might be more like half that. And, you know, you're talking about less than $100 billion in taxes, although it's a ton of money. On a $30 trillion annualized economy, you're talking about a 0.5% inflation hit one time. Because obviously we're not going to increase the tariffs over and again, over and over and over again. Tariffs are up, and then that creates an inflation level. Now, this doesn't say everything. It's not just about imports and exports. If you're a soybean farmer, China is retaliating by refusing to buy any soybeans. This is not good for you. If you're an importer, your main source of products are an import based, this is probably not good. There are definitely parts of the economy and certain businesses that are going to be drastically affected by these. But we have to look at everything in a broad economic sense. And from a broad economic sense, tariffs honestly don't make a big enough impact to reshape our entire economy. Interesting enough, talking about our economy, GDP numbers. So one of the things that came up earlier this year was what's GDP going to do next? And you might remember a chart I've used in the past where I said that since 2000, the GDP is, up or down, obviously, grown at about 2.1%. through all those markets last 25 years. That's about how fast it grows. But what's been happening lately? Well, let's zoom in quickly. Last year was pretty good. We had growth all 4 quarters. 2025, we had a negative quarter. And then we had a huge resurgence in Q2. And what are we expecting in Q3? Well, this is a little tough because this is the old joke about data, knowledge, and wisdom. Data is knowing the number, knowledge is understanding the number, wisdom is knowing when to ignore it. There's a little bit of a problem with our GDP number, and I'm going to use this as a sort of a long form explanation. If you think about our economy as a vegetable garden, right? We measure consumption, but GDP, gross domestic product, is supposed to be about what we produce, but we measure how much we consume. So how do we adjust for that? Well, think about that garden again. You can only produce what you grow inside the garden. Right? You can only consume what's actually made. You can't phantom grow things. The only way you can get more than what is grown is to look over at somebody else's garden and trade them. And in the past, we've run what we call trade deficits, meaning most countries sell their excess to other countries. In our case, we're buying their excess and we're giving them our paper dollars. And for some reason, some people think that's a bad trade. But in this case, what's happening is we are taking their stuff and it's allowing us to consume more. As a result, to account for that, imports are net negative on GDP because we're consuming more than we actually made. So it's a negative number. So it hurts GDP. So the more we buy from overseas, the more it hurts GDP. The more we export, the more it helps GDP. And there are a lot of countries out there. You think a lot of European countries, a lot of Asian countries, they're dependent on foreign exports and selling to other countries. We're not. We're usually net importers. We have been now for going on a little over half a century. But why does that matter to the GDP numbers? Well, normally it's pretty steady, and you kind of can account for it on a regular basis. Not so this last go round. So if you look at this chart, this is goods and services by trade deficit. It shot through the roof in Q1. We saw record new amounts of buying, and why would we see that? Well, because we didn't have a normalized, steady market. We had a market where we had an external political force go in and poke it, essentially. What if you're a manufacturer or a buyer or you need what do? You buy everything you can. If you expect prices to increase by what we found out later was going to be mandated to be 30%. So you bought everything you possibly could. Massive new buying, massive new imports, that's a net negative for GDP. So we had negative GDP, but on a normalized basis, if we had a more normalized number, GDP would have been a little bit less than 2%. Conversely, Q2, massive drop off. Why? Because everybody's shelves are stocked. Everybody's full. We bought everything we could, and tariffs were there, but we're not sure how much they're going to be in the future, and things are getting renegotiated. There's no reason to double down and buy even more. So buying of foreign goods dropped off a cliff. That helped GDP in Q2. And we got a huge resurgence in the number. But again, if it was a more normalized number, we'd probably have just under 2% GDP growth. We'd probably have much more normalized growth if we didn't have this big swing in trade deficits. If you think about it that way, it's tough to tell us what the real economic picture is because you have to strip out those pieces. Underlying, the market's growing slightly lower, but at about the same pace that it has for the last 25 years. Why was this so disruptive? Well, it was so disruptive because of this chart. This is inflation expectations. Inflation, as the Fed would say, that genie's tough to put back in the bottle. And let's take a closer look at this chart. This goes back to 2010. And in 2011, remember, we dropped to zero rates. People thought inflation was going to be huge as a result because we had zero rates. And it took us a long time at near zero rates. And we didn't start raising rates again until I think it was 17 and into 18. People's inflation expectations did not go up. And even in 2021, when we thought inflation was on the horizon for the next year, that blue line, this chart didn't peak at 9%. That was what we actually got for inflation. This peaked a lot lower. The gray line, you remember during that period, we used the word transitory. That gray line didn't barely peak. It seemed to barely move. The 5-year expectation was that things are going to go back down to a more normalized number. In April, inflation expectations shot through the roof on both of those long-term lines. That was a big change. That's why the market was so scared during that period. That fundamentally changes the way you invest. If you think inflation long run is going to be about 3% and suddenly it's going to be 4.5 or greater, that's a big change. Now, subsequently, these inflation expectation numbers have dropped down to much more normalized levels, but that's what they were for that quarter, and that changed people's future outlook. And when you change people's future outlook, they reprice things and they change the way they think about things. One of the challenges you have with inflation is how is it actually structured? And let's talk about inflation specifically. So if we look at this chart, you can see on the very, very far side, this is headline inflation. If you look at the very, very far left of that chart, there's January of 18. We started tariffs back in 17. And tariffs would be probably best showing up in core goods, or the orange number there. You can see from 18 to 2021, the orange number barely even registers. We had tariffs that whole period. The next administration kept all the tariffs, strengthened many of them, but we also had a major supply side shock, right? And that supply side shock, because we couldn't get things. Remember, we just could not physically get the goods. We could not physically do the work. We could not be on the sites. We had limitations. We got massive new inflation. And since then, inflation started to come back down. And the last laggard on inflation, which I've talked about in the past, was shelter, and that's been declining. And right now, you're seeing a little bit of core goods go up. But again, it's that far right corner. It almost seems barely noticeable. Now, does that mean it's over in every sector? No, but if you look at this, those green lines, energy prices probably have a bigger indicator on inflation, and headline inflation especially, than tariffs are going to. And you have to remember, inflation is driven by strictly a demand side phenomenon. Yes, it's part of the federal government printing money, but it's too much money chasing too few goods. And usually that's because there's too much demand. We don't usually have too little supply. That's usually not the issue. That is what we had in 2022. That's why inflation peaked at 9%. World War II, 1946, troops came home and they all wanted cars. We didn't have any factories that made cars. We had factories that made tanks. We had a supply side shock, and inflation was close to 18%. 2 years later, it was back to 2. Inflation generally is considered to be a demographic structure phenomenon. So when you think about it, why do most advertisers say the prized group of people is 22 to 55? Because they tend to spend the most amount of money, right? And if you think about that, if you're 35, 45, that's when people still buy snowmobiles and ATVs, and they think about buying second homes. They want to buy bigger cars, nicer cars. What are people doing when they're 85? They're downsizing, they're selling the second home. They're not buying new ATVs and snowmobiles and other toys. They're not paying for college education when you're 85. That's something you did when you're in your 40s and 50s. The biggest spenders tend to be in that category. So if you have a lot of young people, you tend to have a lot of spenders, a lot of people chasing goods. You tend to have demographic-led inflation. We don't have demographic-led inflation. We've got a lot of relatively old people compared to young people, according to a normal demographic structure. So it's hard to generate inflation. There was a reason why at zero interest rates from 2011 all the way, except for the blip in 17, 18, basically to 2020, we couldn't generate inflation. It's because it was a demographic structure. And taking away that supply side shock, you go back to sort of the long-term demographic structure. And if that's the case, we expect inflation to come down. And although for a while we used the term transitory, people said, that's ridiculous. We've been dealing with this for 18, 19, 20 months now. Transitory really meant more like 2, 3, 4 years, not 12, 18 months. And now that we're, 4 years past it, it does look much more like it was actually transitory, that it was a supply side shock. But again, the Fed wanted to fight off inflation. They didn't want to have things get out of control. They raised rates. They wanted to curb demand for the goods that we couldn't get. And subsequently, they wanted to lower the amount that people spent so that we could stop the inflation. Because once you expect inflation, you tend to raise prices in anticipation of it. If you keep doing that, the expectation of inflation can beget inflation, even without any other external stimuli. So you want to be very careful. So why is the Fed lowering rates now if inflation is still a little bit above target? Well, you can see the line is generally it's declined. It seems like it's more favorable. They were unsure about tariffs. That's one of the reasons they were slow to the party. By the way, the Fed is almost always slow to the party. But they're also interested here because of the dual mandate. The Fed has a dual mandate. They want stable prices, i.e., low and consistent inflation, and they want full employment. Let's take a look at full employment. This is a chart of unemployment and wage growth. If you look, the gray line there is unemployment. Its average is 6.1%, 50-year average. Wage growth is 3.8% average growth. Today, we're at 4.3% unemployment. And if you look at this chart, you might wonder at that gray line, you might say, boy, there's not a lot of times where you get this low unemployment. Yes, we're reading a lot of headlines about unemployment. We're reading a lot of headlines about how it's rising. It's rising from near historic lows of like 3.7, 3.8%. So yes, it's going up. There is some softening in the labor market. And you can really see the softening in the wage growth. Wages in 2022 were 7% wage growth. That's a lot. If that continued, that was going to spur wage push inflation and cause all sorts of issues. That's come down to 3.9%, which remember, long-term average is 3.8. So wage growth is basically back down to long-term averages, and unemployment is near all-time lows. The Fed does want to support. They want to make sure that we don't get a huge new rush of unemployment. And why would they get that? Well, because maybe they've been too restrictive. And they were restrictive. They knew they were overly restrictive. They wanted to be. They wanted to tamp down inflation. They wanted to put that genie back in the bottle. But if the labor market's relatively stable, maybe a little soft, and inflation doesn't seem to be getting out of control, it leaves room for the Fed to return to what they call the neutral rate. Not being overly restrictive, but also not being overly easy. What does that look like? Well, it kind of looks like this. This is them trying to engineer a soft landing. Right, we've heard that term a lot. This is a chart of Fed interest rates. What have they done? If you look here on the very, very far left-hand side, this is the 1990s. That was the last time they engineered a soft landing. Again, they were actually fighting off inflation, not too dissimilar to what we saw in 2022. Rates went up, went down a little bit, held there for a while. They actually crept back up at the end of the 90s. And then there was a major economic crisis, and they dropped to the floor. Right? Again, 2002 all the way to 2007, they kept raising them, trying to tamp out demand. Then there was a major economic problem, great financial crisis, and they dropped to the floor. 2014, the Fed was worried that with inflation low, but interest rates so low, inflation was on its way, began gradually raising rates in anticipation of inflation that frankly never showed up. Right, we just saw the chart. The 18 numbers were basically, were under 2%. We didn't see major inflation. And then we had COVID and we dropped the floor back to zero again. The reason I keep saying that is if you look here, that chart, there's a green and blue line. That's about where we think the market's going to go. That's what the green line is what the market expects. The blue line is what the Fed has announced. And the purple diamond, which is relatively small there, is, I'll enlarge that again. The purple diamond is where they think the neutral rate is, which is ultimately where they want to get to. And if that's where they want to get, they're on their way. And the Fed has the room to do it. Because the Fed has the room to do it, they're probably going to take advantage of it. The inflation doesn't seem to be out of control. The unemployment seems to be relatively under control, but they don't want it to get bad. They don't want to force people out because of high interest rates. They want to get to a neutral rate. If they drop back to zero, we're in an economic crisis. And by the way, I'm not saying you got to rule that out. Remember, we start every year, there's a 20% chance of recession. Most of it's for reasons we didn't see coming. COVID, nobody predicted COVID a few months earlier. Didn't exist, as far as you knew, just a few months before it shook the world. There's always a 20% chance of a recession. So if we do see rates fall, it's because we're in a major recession. But overall, the economic structure looks very healthy. And if we go back to this chart briefly, you can see even expectations for GDP are growing at like high 1%ers, 1.8, 1.9%. The unemployment rate is still expected to remain somewhere in the 4s. Remember, 5% is the natural rate of unemployment. And the whole time the Fed is expecting that headline inflation, which they're thinking is going to be 3% around the end of this year is going to keep falling back to about 2.6, 2.1, and 2% in the next few years. Right? This is all very positive news for the economy. The economy looks very healthy overall. The consumer looks like they're in great shape. Yes, there's a little bit of softness in the unemployment market, but for the most part, the U.S. consumer is in great shape. And if the U.S. consumer is in great shape, we're not worried about where things go from here. The one thing that does change, though, is interest rates. A lot of people are talking about how this is going to change housing. I don't know anybody that's ever made a house purchase based on CD rates. And that's what the Fed really controls, is short-term rates. They don't control the 10-year Treasury. That's controlled by the broader markets and their expectations of inflation and economic growth. That's probably already set. I mean, the curve, if they get to 3%, probably would look very natural in its current environment. If we got 3%, the way the curve is shaped would look normal. If that's the case, probably can't expect a whole lot lower rates on the 10-year. If we don't expect lower rates in the 10-year, it's hard for things like mortgage rates to go down. If anything, right now, what is going to happen is, I was just talking to a client about this today, there's a weird effect here. Yes, we lower rates. It means we're all going to get less on our checking accounts, CDs, and money markets. But for a lot of my clients, where the top 10% are 50% of consumer spending, a lot of them aren't saving anything on interest. I asked one of them, I said, what's your interest rate on your credit card? They said, I don't know. I don't pay it. I pay it off every month. Yeah, most of my clients are in that boat. They don't pay any excess interest. They have a locked-in mortgage for a long period of time. They know what that interest rate is, and then they don't pay a lot of floating interest. So if that's the case, is that a major economic boom that rates are going down? No, it's not a major economic boom. It doesn't solve everybody's problems. It's just less restrictive on a short-term basis. And most people make decisions on long-term rates, which are, again, determined by the market. So with that, going back to tariffs, although important, and there are certain industries they definitely affect, ultimately probably don't look like they can rock the economy in and of themselves. Inflation looks like it's cooling down, and the demographic structure that has been in place is ultimately going to dominate the way in which it moves in the future. And lastly, the Fed, yes, is probably going to continue to cut rates, but don't be expecting them to cut to zero. And if they do start to, there's something seriously wrong with our economy. And with that, I'm going to hand it over, and I'm going to have my father talk about our market expectations for the rest of the year.
Good afternoon, everyone. Thank you, JJ, for that explanation of what's going on in the market, especially with tariffs and interest rates. That's very helpful. And right now, it kind of looks like maybe a soft landing for the economy, which is what we want. We don't want interest rates going a lot lower. That would mean problems. But let's switch to the market. Three things we're going to talk about today with the market. Number one, stocks and the valuation on stocks. And we're going to go through why we think the valuation is on the high side and might be a concern going forward for trying to make money in the markets. Number two, we're going to talk about the concentration in the market. It's at a record level. I'll walk you through that as we get into the presentation. Third, we're going to talk about investment discipline. Discipline is a very important word today. Discipline is what makes you money over long periods of time. It isn't about making money last year or the last 2 years. Most good money managers have a discipline they follow. So when things get out of hand or get frothy, they don't fall into a trap of chasing performance. Let's talk about performance. And interesting, a lot of people have already forgotten that we had a roughly 20% correction in the market. When you look at this chart, the gray bars are what the market did for the year, how it ended, like 1980, it ended up 26%. The red dots and numbers are how much we had intra-year declines. So like 1980, the market was 1 point down 17%. And if you look at 2025, we were down 19%, actually intraday I think it was 20%, or technically a bear market, when we got scared about the potential tariffs that John just talked about. Today we're up 14%, might be a little less than that, but big change. If you had gotten out of the market, you missed a huge rebound and you've permanently lost that money. This is a good reminder of we'll always have volatility during the year. That doesn't mean the year will end up negative. So right now, 14%, look at the last 3 years. 3 years of double digits returns on the indexes. By the way, that's on the indexes, which I'm going to show you are somewhat skewed to a small group of stocks. Most money managers are nowhere near that performance because they haven't been concentrated in those areas. Long term, how has the market done? Most of our friends that watch this have seen this chart before. Goes back 20, almost 30 years. You see in the 90s, early 2000s, we were in a secular bear market. See about 98, 99, and we went up, we went down, we went up. We really, 14 years later, we were kind of in the same spot. That's a secular bear market. When that happens, the market moves a lot, but you don't make a lot of money. In 2013-14, we entered what is called a secular bull market. And for our clients, we've been telling them to be positive on stocks ever since 2013, 2014. And that has paid off. Now, we did have a nasty correction during COVID. We had a pretty nasty correction in 22 when the Fed started aggressively raising interest rates. But since then, we've gone up very nicely. The problem is we've gone up a little too much. If you look at the top there, the PE ratio, and remember, PE ratio is price to earnings. If it's what we're paying for $1 of earnings. Right now we're paying $23, roughly 22.9, $23 for $1 earnings. That's historically a very high price. Even if you look at this chart, there's not a lot of times that we pay that much for earnings, and that is concerning to us. It's also concerning how quickly this market has gone up. Now, to be fair, you see the chart behind me. Long term, what we really care about for stocks is what happens to earnings. If earnings go up, we're going to make money. You can see by this chart, the correlation of the S&P 500 index to the S&P 500 earnings is almost perfect. It's near 1.0, which is perfect correlation. That said, we're very bullish long-term on earnings. We think earnings are going to be good. The problem is we're paying a lot for earnings right now. And as you can see from the chart, there are periods where earnings actually go down for a little while. It happened in 99, 2000 after the bubble crash. It happened in 2008, 2009. It went down a lot. It happened during COVID. So even though long term we're still very bullish, we like what we're seeing here, short term we're a little bit concerned. Speaking of earnings, here's earnings growth going back 25 years. Two things drive earnings. You can see there margins, that's the dark line, and then revenues, which is the lighter green line. So companies get better sales, get better margins, and earnings go up. With the exception of the two big years there, which were recovery years off of bad earnings, what we've seen the last 3 years, you see 2025, we're going to have 10% earnings growth after 10% the year before. And projections have us up 14 and 13%. If you look at the top left, the long-term earnings growth, 25 years, is 7.3. The last 2 years, including this year, have been very good. And the market's very happy about the next 2 years. Since we're paying a high price for earnings, we need that to happen. We need that to be good years. But right now, this is why the market is at all-time highs. The outlook is very positive, and that is bringing us to higher valuations. Now let's talk about valuation. And this is a chart of PEs going back, again, 25 years. And you're going to figure something out real quick here when you look at this chart. Even if I didn't tell you what this chart was about, if you looked at it and I asked you, where is that line going next? Anyone looking at that chart would say, well, it looks like it's on the high side, it's probably going down again. I think that's correct. I think it is going to come back in. We're now very close to what it was during the dot-com bubble, where we were paying 24 times forward earnings for companies. That's a risky price. If we just came back to 20 times, which by the chart is still on the high side, going from 23 times to 20 times earnings is a 15% decline in the market. If we went back to the average of 17 times, which by the way is what we did 3 years ago when the Fed was raising interest rates, back to 17 is a 25% decline in the market. And that assumes we still get high earnings, 13, 14%. If we don't get high earnings, you could have a 30+% decline in the market. So we're just very cautious. Back in 21, we were very cautious on the market. We thought it'd be hard to make money. We didn't predict a bear market in 22, but we got one because the Fed got very aggressive raising rates. So this could easily come down from this level. Now, it also, people could get euphoric and just keep driving prices up. That's what happened in 98, 99. Money kept pouring in the market. So I'm not saying there's a correction tomorrow or a bear market tomorrow, but you should be on the cautious side. The other reason you should be cautious is these next two charts that talk about the PE on the top 10 companies in the S&P, and we're going to talk about the weight or the concentration of those companies. Let's look at the first chart. This is the PEs. The top 10 is in green. We're at 140% of average, which means we're way above average. Not quite where it was during the dot-com bubble, but we're definitely well above the averages. And even the remaining 490 stocks are above average. So right now, your history is against you. It looks like we should be coming back down. But even more dramatic than that is the concentration of the market. Remember the S&P 500, it's called 500 because there's supposed to be 500 stocks. We're supposed to be diversified. Well, in this case, 10 stocks are 40% of the index. And because of this, most people managing money in the last several years, and we track some of the best growth managers out there, we'll talk about that later, they have not kept up with the index because of this excessive concentration and a small group of names. Now, this is the top 10. You've probably heard about the Magnificent Seven. The Magnificent Seven were most of the performance in the last 3 years. If you didn't have a huge overweighting in those, you did not do well. Notice, too, that the top 10 are a bigger concentration than they were during the dot-com bubble. The good news, the top 10, that green line underneath, the earnings are 32% of the market. So at least the earnings are somewhat coinciding with their concentration. But if those earnings turn down, the concentration is going to come down. Here is a chart. It's called the IBD Mutual Fund Index. This comes from Investors Business Daily, which is a newspaper I've been reading for 40 years. It's very well known in the industry. And this proprietary index they put together shows it actually has 20 mutual funds in the index that they have deemed to be some of the best growth managers, growth mutual funds in the business. Actually, one of them is a fund that I was associated with when I was at Oppenheimer 18 years ago. But these guys are supposed to be the best of the best. You can see by this chart that back in December of 21, way in the left hand, when this peaked, this is the performance of the composite. They dropped dramatically in 22, about 35%, as we entered that bear market. What's interesting is they came all the way back, then we had another correction. That was April this year. That's that big V you see down, or March of 25. They fell another 25, almost 30%. Now they've recovered. This index of, again, top performing mutual funds is still 15% below its old high. And the S&P is well above its old high. So why are these best managers not in line with the S&P? Well, because they didn't over concentrate in 7 or 10 stocks. Why is that? Because they follow their discipline. These managers have been around a long time. They're not going to let the individual stock positions grow to double digits, 10, 13, 15, 16%. They will typically trim them and keep them around 4 or 5%. That's good money management. That's what you have to do as a prudent money manager to fulfill your fiduciary obligation. So this bothers me too. If the best managers are not keeping up, it tells me something is out of sync in the market. So between our fear of the high valuations and the fact that a lot of the market participants aren't keeping up because of concentration issues, we're telling our clients to be cautious. And more importantly, we're telling to stick to their discipline. Again, when I was running a mutual fund years ago, we ended up being a 5-star fund. That's from sticking to our discipline. You have a buy discipline, a sell discipline, how you run it. And then you don't chase hot fads that currently in the market. Discipline gives you good performance over a long period of time, but it can be out of whack from year to year. Right now, we're showing you this chart. This chart is the investor cycle. This doesn't change. It's the same way every time. And I know most people say, oh, I don't do that. No, most of the people in the market do this. They get too excited when things are going well, and they get too depressed when things are going bad. So where are we today? We're well past excitement after 3 years of double-digit returns. Now, besides the 3 years of double-digit returns, if you look over the last 6, 7 years, the market's averaged almost 15% returns on the indexes. That is way above average returns. We are at least thrilled, if not euphoric. Now, if we're euphoric, that could last another year or more. That's what happened in 98. Famously, Alan Greenspan in 97 said the market had irrational exuberance. Well, it went up for 3.5 more years. It's hard to call when this change is coming, but it will come. And stocks will start going down, and we'll get anxious, and then we'll deny there's a problem, and then we'll have fear. Remember, every year there's a 20% chance we could have a recession. And I don't think we're going to have one right now, but something else could go wrong. But it is our discipline to make sure that we are trimming things at the top and pulling allocations back to where they should be during a top of a market, which is where I think we're at. On the flip side, when we get down to the bottom of that S curve into capitulation, despondency, and depression, that's when we help our clients and stick to our discipline of not getting out in the market. If anything, we should be adding back to stocks so we can participate in the next part of the cycle. So to sum it up, we think the market is expensive, and I think we have risk of a correction. Correction could turn into a bear market, so we are concerned. The concentration risk is real. We have too much in a few stocks for the indexes. So when we do have a correction, the indexes will fare much worse. And lastly, we want to let you know we're sticking to our discipline. We're not going to change what we do. We're not going to chase performance. We're not getting into exotic products. We're going to keep doing what we've done every day and over a long period of time that would have worked out well for our clients. So thank you again for your time. Send us your questions, and we'll look forward to talking to you next quarter.